Good morning, good afternoon, good evening, wherever you are listening to me. Welcome to another episode of Wealth Building Conference. My name is Oludare Fasola. I want to thank everyone that have been joining us since the beginning of this program. I want to thank you for your time. I understand that time is very, very important in this part of the world. I really appreciate you. And I want to assure you that tonight, the little time we're going to spend together, you have value for your time. But just the usual way before we start the program, we just need to meet ourselves. Wherever you are listening to me, I want you to please type your name and where you are joining from. If you are joining from Canada, I just want you to type Canada and your name. Again, this is going to be an interactive session. So, it's not just anyhow webinar used to go, right? It's going to be very engaging and interactive. So if you have any question, you can drop it on the comment section so that we can, treat that at the end of the program. I also want to, appreciate all the World Building Team Conference. It's been an amazing time, putting everything together every week to educate our people on how to build wealth and how to also scale their business. So tonight we're going to be talking about how medical professionals, how we can actually help them to build wealth. I've been saying that on several occasions that it's not how much you make, but how much you can actually save on taxes. And I used to say this like, I don't have any problem for paying taxes, but if you can explore legal way of saving as much as you can on taxes, it's going to make a lot of sense. According to Canadian Medical Association, an average medical professional pay combined, if your income is not structured properly, about 45% in taxes. Imagine that. So that's not just a number, but it's a reflection of what is actually going on in Canada. And so other part of the country as well, United Kingdom, United States of America, tax is number one biggest destroyers of wealth. If you don't know how to properly manage tax, it's going to be extremely difficult for you to build wealth. So I want to say, the more you learn, the more you understand that I need to do more to save as much as I can from taxes. Once again, thank you so much for joining. Again, whatever I want to share tonight, I want you to implement it. There's no point coming to a webinar and at the end of the day, you listen and you don't implement what we have discussed so far. So I want you to please go back to your accountant, go back to your financial planner, your financial advisor, and discuss this with them if it makes sense for you to incorporate. So, many times we feel that incorporation is the solutions to one of the way to save taxes. Of course, it is, but not all the times our incorporation makes sense. So we're going to look at incorporation, pros, cons, and the tax trap. While should you incorporate as a medical professional? What are the advantages and disadvantages, and what are the tax trap that you medical professionals should understand? So I'm going to quickly pull up my slide and we go into the presentation. Once again, tonight we're going to be looking at should medical professional incorporate, pros, cons, and tax trap, right? Pros, cons, and tax trap. Now, I've met a lot of medical professionals, and the first thing, like, some of them will say, like, my accountant said I should incorporate. Of course, it's good to incorporate, but do you know that not in all cases, you must incorporate? There are people that you don't really need to incorporate. There are categories of people that need to incorporate. So we want to look at what are those people that are supposed to incorporate, and those people that are not supposed to incorporate. What are the advantages of incorporations? What are the disadvantages of the incorporation? And what are the tax trap that you as a medical professional should take note of? Right, let's quickly do a very quick housekeeping, right? So this presentation does not constitute legal, tax, or financial advice. Please consult your licensed professional before making any decision, right? So this is not a professional advice. So you also need to consult your accountant. You need to consult your financial planner or your financial advisor before you can implement any strategy here. So the objective of today's webinar is to help you understand when incorporation makes sense, when it doesn't, and how to avoid costly tax traps that high income earner often fall into. Like, not every time, right, incorporation makes sense. So we're going to look at it as we proceed. So why this matter? Why do you have actually come on with about this topic? Like, I've been doing a lot of research on why and how medical doctors can build wealth. One of the things I really see that is really affecting you as a medical professional is taxes. The biggest challenges you as a medical professional are facing today is number one, taxes. Number two, retirement planning. According to MD Financial, about 40% of medical professionals delay their retirement. Of course, why do you have to delay? Why do you have to delay your retirement? Because of lack of retirement planning. That's another topic we're going to talk about maybe in the next episode of Wealth Building Conference. But today, we want to look at why is, like, should you incorporate? Like, if you are already incorporated and you also need to sit down, like, listen to this webinar today. Like, does it really make sense for me to incorporate or to continue incorporation, or I have to shut down my incorporations and start, operating as a sole proprietorship or, non-incorporation medical professionals, or should I continue, right? Most medical professionals and business owners earn well, but keep very little. Like, just like I mentioned, just like, my first statement, that according to Canadian Medical Association, okay, combined taxes of an average medical professional is about 45%. So combined, when you pay yourself salary or you pay yourself dividend, you pay your corporation tax, you pay yourself, you also pay tax on your, passive income, which is your retained earning. It could probably around about 45%. Yes, right. Imagine you make about $100,000, $200,000, and you pay about 45% in taxes. And that's why you ask yourself at the end of every year, like, I'm working so hard, but like, I cannot even see the money, right? And I discussed that, I think, in about 2-3 weeks ago, I talked about profitability and cash flow, right? That you are profitable on paper does not mean that you have enough cash flow to back up your operation. Some medical professionals, they are very, very profitable. When your accountant prepare your profit and loss, you have a lot of retained earnings, but in your bank account, you have nothing to show for it. These are some of the problems you are facing, right? It's probably you have incorporated wrongly, or you are actually, some leakages in your finances that you don't really look at. Let's look at it. High taxes. 35 to 53% of income lost to taxes. Like, I'm going to break it down into several places, right? So if you pay yourself salary, depending on your province, right? For example, in Ontario here, you could probably pay between 20 to 30% in taxes, 40% in taxes. It all depends on your tax bracket, right? That is salary. Now, if you also incorporate, you pay corporation tax of about 12 to 13%, depending on your province, depending on your tax, bracket, right? Also, when you now make money, like your retained earnings, you invest that, and you make more than $50,000, you still pay about 50% taxes. That is the reality. But do you need to continue to pay these taxes, right? You need to sit down and strategize on how much can I save from taxes. And let me tell you, I'll be very, very honest with you. Your accountant cannot build wealth for you. And I'm saying this with boldness, that your accountant cannot build wealth for you. It is your responsibility to sit down and strategize on how can I build wealth, especially outside my corporation. Okay? Because why? If your job, your accountant's duty is to help you, maybe to prepare your books of account, to help you to file your taxes, it is your duty to sit down and see, how can I build wealth outside my corporation? Number two, no investment structure, missing organized wealth building system. So you need to ask yourself, right? How can I build wealth, especially me as a business owner? If I retire tomorrow, right, do I have enough money to take care of my retirement? right? You need to ask yourself that. Your accountant will not do that for you. Again, relying on registered retirement savings plan contribution. A lot of you, what your accountant tell you that's okay, once you have your corporation, like, put money on RRSP so that, it's a way to plan for your retirement. Is we call it deferred retirement strategies. Like whatever you put in your RRSP right now, you save the taxes, but when you start, withdrawing the money, whatever time you are ready to, take out the money, you're going to pay the tax back, right? Of course, it's a very good strategy to save on taxes right now. We call it the fast strategies, right? But is it the only thing that you need to do? You need to also ask yourself, can that alone help me to plan for my retirement? And again, no separation, business and personal finance mixed, right? A lot of you as a medical professional, you don't separate your business from your personal finance. This is where you have so much leakages. Now, you go into your corporation, just pull money out. Your personal finance, you put in the corporation. Your corporation, you put in your personal finance. And when your accountant is preparing your books, start asking you a question, where is this money coming from? Where is this one coming from? It doesn't have to be like that. You need to be very, very organized. It's your money, but you have to make sure your finance, you keep it in such a way that it will be easier for you to know, where do I stand? Because we are mixing personal and business together, you cannot really differentiate where you stand. What is incorporation? What is incorporation? It's a very simple question. A lot of you incorporate, but you don't even know what incorporation means. No. An incorporated medical practice creates a professional corporation, which is called PC, that separates you from your business. What does that mean to you? Your business is a legal entity that can be sued and be sued. You as an entity different from your corporation. That is what corporations mean. So your corporation, in the eyes of law, is a legal entity, right? So and that's why you see a lot of, like, when you set up your medical corporation, you see James Medical Professional Corporation, Olu Medical Professional Corporation. So that is how it's actually, and you are not supposed to do anything outside your corporate practice, inside your corporation. What are the advantages? Number one, corporate tax advantage, lower tax and strategic planning opportunity. When it comes to corporation, you can enjoy as much as 12, 13, 14%, depending on your province, depending on your tax bracket. So meaning that at the end of the year, when you prepare your book account, right, your income, your gross income minus expenses, all right, remaining profit before tax, apply your corporation tax of about 12%, right, or 13%, as opposed to if you are not incorporated. So you enjoy, technically lower tax bracket where you incorporate. Number two, wealth building engine. Act as financial infrastructures for growth. Now, your corporation enjoy what we call a tax deferral strategy. So, it is another powerful way to build wealth. So a lot of you see, it's not just a professional corporation, but it's a powerful strategy to build wealth. Three, strategic planning, family, retirement, and insurance strategies. Your corporation can also be a very good, powerful strategic planning for your family, for your retirement, and for insurance planning. Now, let me just explain a bit of that for you. When it comes to you as a medical professional, one of the things that is also another biggest problem that I see is estate planning. A lot of you are building wealth, but you don't really sit down and ask yourself, if I have XYZ asset, like, what are the strategies to protect this asset, right? Now, what about my family? If anything happened to me today, can this incorporation even survive? What about my family. So what smart professional, medical professional do is to set up a corporate life insurance on their corporation. The advantage of that is, number one, is a very strategic way of saving on taxes. Because why? If you make your corporations to be the owner, to be the beneficiary, to be the payer of the insurance premium, technically your premium enjoy lower tax bracket, about 12%. So instead of you to take out dividend or you pay yourself salary, you enjoy 12%, on your premium, as opposed to maybe 20%, 30%. That is how powerful your incorporation is. Now, let's look at the advantage: massive tax savings. When you have a corporation, your tax bracket can be between 12 to 13%. As I said earlier, it all depends on your province. It all depends on your tax bracket. For example, in Ontario, probably about 12% when you do your incorporation line. I'm just going to give you a breakdown of it. Like, how do you come about 12% corporation? When you make your money, your professional corporation make money. Say, for example, you make $500,000 in a year. Your expenses is about $250,000. Okay, deduct that from your gross earning, give us a profit before tax of about $250,000, right? You apply 12% to $250,000, giving you a retained earnings. Imagine if you don't incorporate and you are about to, like, you're a sole proprietorship, you probably pay as much as about 53% in taxes. Again, 50 personal tax rate, you can pay as much as 53% taxes. I'm talking about both personal, both your incorporation and on passive income. You could pay as much as 53% on taxes. Let's look at an example of, let's say this is a particular doctor earning about $400,000 in a year. All right. So if you don't incorporate, you probably lose about $180,000 to taxes. If incorporated, you keep $40,000 to $60,000 more annually through strategic income distribution. That is how powerful your incorporation, when you incorporate your medical corporation. And you know what? We are saying this today because I've seen a lot of medical professionals that will like say, oh, my accountant said I shouldn't incorporate, or I don't think I need to incorporate. This is the advantages of incorporate your practice. Now, pay yourself smarter, not harder. Now, let's look at the second advantage: income splitting and retirement planning. One of the important aspects of, one thing that I really also focus on right now is how can I help more medical professionals to prepare for retirement, right? Some of you are prepared. If I ask you right now, are you preparing for retirement? The answer is yes, right? The answer is yes. But here's the question: are you prepared? Is it enough? Look at your lifestyle right now. Okay, with the way I'm living right now, how much can I set aside that will help me to retire with peace of mind? Strategic compensation: pay yourself salary or dividend based on tax efficiency and personal needs. Like, a lot of people ask, should I do dividend or should I do salary? It all depends on you. But let me explain this to you, right? I used to tell you can do both, because both also have its own advantages and disadvantages. But when you pay yourself salary, you're actually contribute to CPP. You also have opportunity of lending, because why? If you want to go for mortgage and all of that, those are the things they're going to look at, and so many other, CPP, OAS, and all of that. You will enjoy that when you pay yourself salary. Of course, if you do dividend as well, it also have this on it. So, as I said, right, it all depends on what work for you and your financial goal. Again, corporate savings: retain and grow earning inside a corporation at lower tax rate. So, as a professional corporation, okay, whatever you have in your corporation, enjoy deferred tax strategies. Like, you can defer taxes till as long as you live, right? Again, you can actually, pull out your retained earnings and also invest in your holding company. Right now, whatever profit you make at the end of the year, right, you don't want to, put it back into the income to your professional corporation. You can actually have a holding company, right, where you actually invest your profit, and that also can also become a wealth building, planning for you. If you are getting value, I want you to put in the comment section value. If you are getting value, put in the comment section value. Tax efficient insurance. Use corporate life insurance to build wealth with tax advantage. A lot of times I've seen many medical professionals, when we ask them, do you have life insurance on your corporation? They'll say probably no. Guys, you are putting money on the table for CRA. You are putting money on the table. Life insurance, corporate life insurance, whether whole life or universal life insurance, is a powerful way to save on taxes. I'm going to tell you how. If, for example, okay, you set up a life insurance, you are paying X amount of money. Let's say, for example, you are paying $3,000, $2,000 on life insurance policy. Okay, the premium you're paying on your life insurance, please be careful, it's not tax deductible. If any advisor is telling you that, oh, your premium is tax deductible, I'm telling you the answer is no. Okay, because you want to double dip. The benefit is tax free, so you cannot double dip. Okay, now the premium you pay on your life insurance is not tax deductible, but because the corporation paid the premium, okay, the corporation is the owner, the corporation is the beneficiary. All right, the premium enjoy the corporation tax advantage of 12%, especially in Ontario. So if you pay 24% annual premium on your life insurance policy, multiply that by 12. As opposed to if you pay yourself salary and you are paying about 20-30% on taxes. So you can see the advantage. That's the advantage. It's a very, very powerful tool to build wealth, right? Holding company structures, protect and grow assets through holding company strategies. Like you see what you have worked for, labored for many, many years. A single litigation can consume everything in one day if you're not careful. I'm talking to you as a medical professional. Okay, you must be very strategic in the way you build wealth. If you make profit, please invest that outside your corporation. It's wisdom. Because why? It actually saves from litigation. It's also protected from creditors. Because I've seen a lot of medical professionals in the past, like they are building everything inside their corporation. No, it shouldn't be like that. You have to build outside your corporation. Invest your retained earning on your holding company. That is how smart doctors build wealth. Enhance retirement. Implement IPPRCAs and IP strategies beyond basic registered retirement saving plans. So these are another powerful way to build wealth. Don't rely on RRSP alone. There are other strategies that you can actually implement to build wealth. See, you need to diversify your asset, right? Don't put your egg in one basket. Diversified. Incorporation is not just a tax tool, it's a wealth building engine. You need to know that. Because I've seen a lot of medical professionals, they work for so many years and they have nothing to show for it. Why? Because they don't know how to leverage on their medical professional corporations to build wealth. It's very, very important. And I'm just telling you today that, look, you can retire early in your life. What about monetizing your skill? You can actually do this. You are a family physician, you are a surgeon, you are a neurosurgeon, you are a gynecologist. Monetize your skills, write ebooks, put it on Amazon, put it on where you can sell $2, $3, $5, $10. It compound over time. It's another way to build wealth. It's very, very important. Now, 3, more flexibility and control. More flexibility and control. Choose how and when to pay yourself, right? Let me tell you this, right? In the last 3-4 years in Canada, we've experienced serious, market crash in real estate market. And I know a lot of medical professionals that put a lot of money in the real estate market. It's good. Imagine if you are planning your retirement towards, if let's say, for example, you retire in the last 2-3 years and you put a lot of money in real estate and the market suddenly crash. What happened? Right? But if you do salary, right, you pay yourself salary, okay, you remit your pension, government. It's not much, but imagine what will that be if you are not in Canada, you are in another country, like you retired, and that money is coming to you every month. It's going to mean a lot to your retirement, and that is why I do advise every doctor, you need at least have several ways of planning for retirement. Do a little bit of pension, do a little bit of real estate, do franchising, put your money in life insurance, and of course, put your money on investment like stocks, like bonds, like REIT. It's wisdom. So you don't want to put your egg in one basket. Retain earning, keep profit in corporation for future use. So as I said earlier, right, your retained earning is another trap to enter into another tax regime. So your retained earning, you pay 12% on your corporation, right? Your retained earning, if you are not careful, you can pay as much as 50% on taxes. If, for example, you invest on real estate, or let's say you invest on stocks, and you make more than, let's say you invest $50,000, you make $100,000, that $100,000 is subjected to, passive income tax. You can pay as much as 50% tax on that. So, and that's another level of taxation that you, as a medical professionals, you need to be very careful and guide your money from CRA. Okay, tax timing control. Decide when to trigger personal tax. So this depends on what you really want, depend on your financial goal, depend on your financial objectives, right? If you want to pay yourself salary, if you want to pay yourself a dividend, it's up to you. So, but it actually gives you more flexibility on what you want to do. Like, if you want to pay yourself salary, it's okay. If you want to pay yourself dividend, it's okay. But you have that control, you have that flexibility. You can do that this year and next year. I say, I'm not going to do that again. I want to change to this one. It gives you that, it's your corporation. But when you are doing that, you have to be very, very careful and make sure that you work your accountant to make sure that you guide against all the regulations, especially, as regard to the tax law. Deduct legitimate business expenses. So when you have a professional corporation, all your travel, everything that relates to running your professional practices, you can claim that as a business expense, and that's another tax advantage for you. Whatever you make, whatever your gross earning, your expenses, your medical expenses, your professional training expenses, anything that actually, as long as it relates to your professional practices, your gas, your insurance, your telephone, as long as it actually relates to your professional practices, you can claim it. Your corporation will give you that advantage. Liability protection, right? Liability protections. Shield from certain business liability. If you have every medical professionals have a liability protection, you can actually claim that in your professional corporation. And professional image, enhance credibility and presence. When you are incorporated, it gives you this credibility that you have a company that people can say, hey, this person is a legal entity. Like I said earlier, your corporation is a legal entity that can be sued and be sued, right? So it's actually it separates you from your personal self. So your corporation standard, and that give you more credibility, give you more trust people to deal with you. Keep more money working for you inside control structure. These are the cons, right? So everything that has advantage also has disadvantage. So let me just break that one. When incorporation doesn't make sense, number one, you are required every dollar for living expenses. Like, say, for example, you need all your money. Honestly speaking, you don't need to incorporate. Like, you don't need to. If you're any under $120,000 annually, incorporation does not really make sense to you, right? So, because at the end of the day, by the time you claim all the business expenses, you realize that what is going to be taxed at a corporate level is very, very, very small. So why incorporate, right? So maybe you are just entering into professional practices. You are still doing your course. I've seen a lot of medical professionals. They just started, right? They are doing one courses or the other. They want to have their own clinic. I mean, at that point, you just need to be doing, just keep it low. When it's time for you to incorporate, your accountant, you yourself, you will know. Poor record keeping, inconsistent with bookkeepings and admin. One of the things that can quickly kill your incorporation is inadequate bookkeeping. Now, see, that $20, $200 you are paying to your accountant for preparing your books of account, it gives you a lot of opportunity. So if you are not that kind of person that know how to keep proper record, don't go into incorporation, right? Many times, like, I've seen many medical professionals, their bookkeeping is extremely cumbersome, right? So you need to be very, very, up to date in your bookkeeping, because like this is what your book of account is, something that shows your performance and how your company is doing. Like, if you want to have problem, right, it actually start, your bookkeeping will reflect on what you are doing. For example, if you are over trading, for example, your bookkeeping will show, right? If you have more liability than your asset, your bookkeeping will show. Like, a lot of people have so much, they've taken a lot of debt. Like, if your liability is maybe times 4, times 5 of your asset, that problem is coming. And they can only know this if they prepare your book of account. So you can see that your book of account is very, very important when it comes to incorporation. So you must be able to do, it's a must. You have to do it, right? Don't want payroll or administrative responsibility. If you want to avoid payroll, then it doesn't really make sense for you to incorporate, because at the end of the day, you're going to pay yourself. So at the end of the month, you pay yourself, you remit your pension, you remit your this, you remit your that. If you know you don't want to go into that, it doesn't really make any sense to incorporate. Right. Moving provinces or returning to school soon. If you know that I'm not going to stay so long in my practice for now, maybe I want to work for maybe few months, few years, and I want to go back to school. When I come back, maybe I will start in a very big form. It doesn't really make any sense for you to incorporate. Like, you are not really starting in a very big. It doesn't really make sense for you to incorporate. Like, short time planning to close practice in near future. If you are planning to very close quickly, it doesn't really make any sense for you to incorporate. Right now, these are the tax trap for every medical doctors must avoid. These are the tax trap every medical professional must avoid. Number one, tax on split income. Paying dividend incorrectly to family members result in 50% tax penalty. Like, this is what we call TOSI, tax on split income. If it is not done properly, it can result to, punitive tax from CRA. You have to take note of that. Number two, passive investment taxes. Too much investment income inside corporations reduce small business deduction, and that is why you need to start your holding company, right? Once you start making profit from your corporation, it is time for you to start what you call a holding company that holding company is going to house all your investment vehicles in your corporation. Whatever you make from your corporation, divert it to your holding company. Let the holding company start, using that to invest. No payroll when needed. Skipping salary affects CPP, RRSP rooms, and mortgage qualification. So one of the things that you must understand as a medical professional is that because you pay yourself salary is a very quick way to qualify you for mortgage, because what the bank will look at is like, this how much you pay yourself. If you are getting salary, you know it actually qualify you for learning, for lending. Like, you want to take finance, you want to buy house and all of that. you know this is, if it is not properly managed, it's going to affect that. It's also going to affect your contribution, RRSP contribution room, your TFSA contribution, because it's actually based on what you pay yourself that they're going to calculate those ones at, right? So you must manage it well. These are the tax trap that you must also avoid. Wrong salary stroke dividend, right? Incorrect balancing cost medical professional tens of thousands of dollars annually. If you don't have the correct mix of, should I pay myself salary? Should I pay myself dividend? Right? It a tax trap that you must avoid. My advice, my recommendation, please talk to your accountant. Let them advise you rightly, especially as you are moving to 2026. Seriously speaking, sit down and look at, audit yourself. Like, how much these are things, this is how you will know. What is your RRSP room? Like, how much do you have there? Your TFSA, all those things is very, very important. Your RESP for your children is part of what you actually need to look at. Your FHSA, if you are a new medical professional and you are about to buy your house, it is very important that you maximize those areas. Like, you need to know that, do I qualify for FHSA? If I qualify, what is the limit that I can put in, right? Your TFSA, right, is one of the best accounts you can have as a medical professional, because it grows tax free. Maximize it as much as you can. Whatever income you have, right, if you have retained earning, right, ask, sit down with your financial advisors, to insurance broker. Let them look at some strategies or investment you can put this money in that will continue to gain compound interest. The earlier you start, the more easier for you, at the end of the day. Now, what most medical professionals get wrong, these are some of the things that you get wrong. Number one, tax only focus. Thinking incorporation is only about tax savings, missing wealth building opportunity. A lot of you believe that, oh, it's just about so once I incorporate, it's going to help me to save on taxes. No, incorporations go beyond that. It's going to help you to build wealth. Think about your holding company. It's a powerful engine to build wealth, right? Your incorporation is also a defer strategist. You can defer, taxes till future date. It's a very, very powerful strategy for retirement planning. No professional team, like failing to build proper team of CPA, lawyers, and financial advisor. We at Wealth Building team, we have professionals that will help you to look into your taxes, look into your your estate planning, look at your mortgage, look at your real estate, look at your insurance solutions. We have team of professionals that help you to do that. So we are not just going to just sell insurance to you, or maybe help you to buy the house and leave you. No, we are going to make sure that we grow with you and make sure that you help you to grow wealth while you focus on your medical practices. As you are taking care of your patient, we at Wealth Building Conference, we're going to take care of your money. It's very, very important. Set and forget, setting up once and never reviewing or updating the structure. This is very, very important, right? How long, when did you audit your finances? When did you audit your investment? When did you audit your retirement planning? This is very, very key, right? Your accountant will not do that for you. It is your responsibility. You sit down with your advisors. Let me audit myself. Let me audit my finances. Let me see where I am as regard my retirement planning. A lot of you don't even plan for your education of your children. Like, just feel like, oh, when they get to university, they're going to sort it out. No, you have to start now, right? And guess what? RESP is not enough to give them that education they want. RESP is not enough. So you have to plan beyond that, right? You have to plan beyond that. right? It is your responsibility to make sure that you do that. So you don't need to set it up and forget it. Every year you must sit down with them and do annual review. And this is what we do at Wealth Building Conference team. We make sure that every of our medical professional team, we sit down with them, review with them what's working, what's not working, how we can diversify. If they're overtraining, we advise them. If they have so much liability, we'll let them to say you are overtraining, right? This is not good for you. We advise you. We are going to advise you, and it's up to you to take advice on it. But here the thing, right? We want to make sure that you grow with us, right? As you focus on your medical practices, we're going to help you to build wealth. Ignoring insurance. Why? This is very, very important, right? Overlooking insurance planning that protect the corporation. Let me tell you, you are the only important asset that you must protect. If you cannot go to clinic tomorrow, will you make money? The answer is no. If you cannot go to clinic tomorrow, will you make money? You can't. So your corporation, your investment, your this, it's because you are making money, right? Make sure you protect what matters first. Don't ignore insurance. As a matter of fact, life insurance is the foundation of everything. So it's the first thing that you must consider before you do any other thing. Poor compensation. Okay, avoiding proper payment strategies that optimize tax efficiency. I used to recommend, like I used to advise, do salary, at the end of the year review. If there's any way you can do dividend that will help you to optimize your taxes, do it. But you know what? Talk to your CPA to know which actually work for you, because I am not here to give you financial stroke investment advice. Okay, no long-term plan. Missing comprehensive wealth building and retirement strategy. So now you also need to understand that as I progress in my practice, as I move on with my practice, I need to continue to build wealth outside my corporation. I need to make sure that I plan enough for my retirement, or especially if anything happened to me. For example, I'm not able to go to clinic. You have enough critical illness. You have disability insurance that will take care of me if anything happens. Incorporation is a system, not a startup. Incorporation is a system, not startup. So next step, let's quickly summarize what we've been learning so far. Incorporate if, number one, you earn $180,000 annually. You don't need all income personally. Okay. Wealth, want tax efficient wealth growth, desire long-term control and flexibility, are willing to plan strategically. Avoid if you need all the income immediately, want to maintain proper record, and under $120,000 per annum. So I want to thank everyone for joining tonight. It has been a very, very fantastic session. If you gain value tonight, please, I want you to put on the comment section value. If you gain value tonight, I want you to put on the comment section value. If you are a medical professional listening to me tonight, if you lack clarity, like, you want more, and you kind of, you don't really know what's going on with your finances, please book a pre-clarity call. I'm ready to show you how you can build wealth outside your corporation, how you can plan your retirement plan in such a way that it's going to help you, to have good retirement planning. Many of you're working so hard, but you don't keep as much as you can, right? It is very, very important. Once again, I want to thank everyone that joined tonight. If you have any question, you can put on the comment section so that we can actually, quickly look into it. If you have any question, please put it on the comment section. I want to thank all the people that have joined tonight. Onon Daniel, thank you so much. Olubola Fasola, I want to thank you so much. Esther, thank you so much for joining tonight. And Adekunle Adewale, oh wow, thank you so much. Oludare Oluyemi, it's really nice to have you guys here tonight. You really, really make my day. I want to assure you that next week we're going to be looking into another topic. But if you have any medical professional, please send the links to them. Let them listen to this amazing, webinar. It's going to open their eyes to see how they can actually plan for their retirement, how they can build wealth outside their corporation. Is very, very important. So, in the absence of none, I want to bring this meeting to a close. Once again, thank everyone that's joined tonight. See you next week, and bye for now.